Can the world's biggest banks survive another major crisis? It's a scenario US regulators want the financial industry to be prepared for, and its latest stress tests show most of those considered too big to fail are now strong enough to survive. But the American unit of one of the world's biggest investment banks did not get the all clear.
This is the US business of Deutsche failing the US stress tests, and yeah, that's a big disappointment for a bank that's already under pressure. But I don't think it's a big surprise. They have failed this test, I think, twice before. But I think it just underpins the message that they have a lot more reform to do. So not a shock, but certainly another disappointment.
The US Federal Reserve also raised concerns over Goldman Sachs and Morgan Stanley. But 31 of the biggest banks got the thumbs up from regulators, clearing the way for higher payouts for shareholders. JP Morgan Chase says it will raise dividends by 43% and buy back shares worth $21 billion. Citigroup will spend nearly $18 billion to repurchase its stock and says it will raise payouts by 41%. And Wells Fargo wants to spend $24.5 billion on buying back its shares while also raising what it pays out to investors. The results suggest the financial industry has come a long way in the decades since the global financial crisis, but they also show that troubles at one bank could still threaten the industry. Mobin Nasir, TRT World.
Well, Max Wolff joins us from New York for more on this. He's the chief economist at the Phoenix Group. Good to have you with us again. Deutsche Bank, just last month it announced it was cutting 7,000 jobs. In April, Standard & Poor's cut its credit rating, and let's not forget the $7 billion fine that it's agreed to pay US regulators over a financial scandal. I mean, it's not looking good for Deutsche, is it? But I'm wondering, what does this failure of this latest stress test mean for the former German giant?
So great to be here. I think the sad story with Deutsche Bank is it hasn't fully bottomed out and turned the corner as decisively as the sort of more bullish names on the shares had sort of thought. We had hoped that we'd put in a bottom, a little bit less clear. Generally, the knock on these stress tests writ large is that they're a little bit less convincing than they used to be because the barriers have been pretty much relaxed. There were 35 banks in the major discussion, 34 pass, one doesn't. Really highlights Deutsche's weaknesses. Nothing really new here, and there are some good signs that they're beginning to turn the corner, but I think it strongly suggests there's more work to be done and probably more shrinkage in the cards for what was once a very important player here in the US capital market.
Yes, it was quite a different story for its US counterparts, with the majority of US banks passing the latest stress test. I'm wondering, can we expect to see a flurry of payouts to shareholders now that the US Fed has effectively given the green light to do so?
Yeah, so the Fed gave the green light to most parties. I think a little bit surprisingly, Morgan Stanley and Goldman Sachs were told they could not really use financial engineering to better the prospects in the near term for all of their employees, because in the worst possible case scenarios, they might run afoul of the 3% minimal capital loss cushion. But everybody else, including the big names, the household names, were given the green light, and they've already begun the process of announcing pretty generous share buybacks and dividend increases. So it's pretty clear that the recent surge in profitability that American financial firms have done two things. One, they've sort of increased the balance sheet strength, and that's the good news on 34 of 35 passing, but they've certainly also increased the calls and the appetite among shareholders to be actively compensated in buyback and dividend form, and we see most of the major banks answering that call, save maybe the big investment banks, who are going to have to wait because they're going to have a particular interpretation applied to their minimum capital cushions.
Yes, and these balance sheet assessments, what we call stress tests, are obviously designed to test whether banks can survive future hypothetical economic shocks. I'm wondering, in your view, if it did come to the crunch, do you think they could actually survive them?
Yeah, I would imagine they can. I mean, usually you don't have the same crisis twice, just like you don't have the same opportunity twice. That being said, I would be a little bit nervous only that we're trying to see if there's not a catastrophic systemic failure. It doesn't mean there aren't significant losses. So if we have a nasty macroeconomic downturn, we'll have significant losses. And I think part of the critique I might offer, which I know many others do too, is when we have the next crisis, not if, and it's probably closer than many people think, it won't start in the same way and it won't run the same course, and therefore seeing if we could survive the same type of crisis that we had in 2008, 2009 is smart, makes sense, it's very useful, but it's also pretty unlikely to be a full prophylactic against the next crisis because you can't jump in the same river twice when it comes to crisis.
Okay, interesting times ahead. Max Wolff in New York, thank you for that.